Welcome to our weekly Forex and Futures forecast. As always, we need to remind you that trading is a risky endeavor and not suitable for all investors. My name is Jay Norris. I wrote the book The Secret to Trading, Risk Tolerance Threshold Theory. Hey, it's good to be back. We were away last weekend. That's always nice. But we're back now. Let's get back to the charts. Here's the Australian dollar. Sideways. I mean, it's been sideways. I think that's what we said last time. It's what you're going on over a year of sideways. And if you pan out, you'll see more sideways. Just a larger sideways formation there. So, it's been a little disappointing compared to the other capital markets. On the other hand, it's still producing. When you look at it from the perspective of a longer-term trader buying dips, you could see that that big dip there, and every dip since then has produced. So you can't rule out this guy as a pretty good instrument for buying dips, and you have that overall yield to it. From a shorter-term trader's perspective, though, the day-to-day pattern is down, and that's made for tough sledding if you are that longer-term swing trader. So when the day-to-day is down, you can focus on intraday sell signals. We haven't been, though, and here's why. We're essentially trading with our macro ratio. Here's the big picture for us. That would be the environment, basically the macro financial environment. And you can see you have the majority patterns up. You have that alpha market, S&P 500, the alpha dollar yen up too. So we're not going to go against the alphas, particularly when you have the majority of markets in that ratio bullish. So even though the majority patterns happen to be down, those shorter term patterns, albeit down in the Aussie, we're not really going after the short side. There's just too good a picking as far as dollar yen, S&P 500, even euro US dollar. Euro US dollar has the majority of the patterns higher in line with the macro ratio. So that's in itself why we're not really going after the short side in the Aussie. Next market, euro US dollar. And it's not the healthiest looking chart. You can see that right away. You've got what we call the barbed wire here. You got a big day-to-day sell zone just ahead. You got that primary sell zone. But you know what? That secondary's up, and that secondary's been pretty reliable. This is the same secondary move that started last summer. It's still very much in place. You have the shorter-term intraday patterns in here. Your 20-day pattern, your 10-day pattern are up. And the reason we've been focusing on the long side in the euro more recently is because you have the majority of patterns up. And that when you have the majority of patterns up and you have it in line with that macro ratio, the bigger picture supporting of it, you can't sell rallies. So really, we've been, if anything, we've been looking to buy shorter-term dips here. We got a nice one on Friday. Kind of uncharacteristic for me to go against that day-to-day pattern, but you have to go trade with the majority, particularly when that macro ratio is in support. So what we're seeing is strength in dollar yen, strength in U.S. stock market is lending strength to the euro U.S. dollar. So you're not going to see a big sell-off in the euro as long as you have strength in these other markets. And here's your dollar yen next, really the alpha market. We would have thought when you had that double top, we'd see more of a correction. But I guess this, here was the tip-off. And we were working the long side in dollar yen all week, too, from an intraday basis in our live market analysis, etc. This is a shallow retracement right there, and that's a sign of strength. Here's another one, even a more shallow retracement, and they're going right back to that par level. So you could potentially see a breakout above par. There's going to be some room up above. That's the bottom line. If you look at this guy from a longer-term perspective, you're only at the 50% retracement level of that bear market, of the 07, 08, etc. bear. So you're only at a 50%. What's to say you can't break through there and climb up towards that 618 or 625? So, you can't rule out a breakout in dollar yen just because, it's par level. I wrote an article, maybe I tweeted it. I said 100 in dollar yen, it's just a number. Let's look at your alpha market here. This is really the King Kong of financial markets, the S&P 500. We were saying all along, hey, it's going to get to that all-time high. I was like a broken record on that because it just had the momentum, and it got to the all-time high, and it hasn't slowed down any. We covered this, I believe, 2 weeks ago. I was saying, if you look at this chart, look at a monthly, you have to think this is a sideways range. Market's been in a sideways range for 13 years. Now you have a potential breakout here. So from our perspective, there's room up above. We pointed out a couple weeks ago when we talked about the possibility of this breakout, we were saying, hey, when it comes to U.S. debt, actually U.S. debt, government debt's actually going down, the budget deficit's going down, and people are saying, well, how can that possibly be with all the bond buying the Fed is doing? Well, the U.S. government has a couple of different branches here, right? The Treasury and the Federal Reserve. The Treasury issues the bonds, the Federal Reserve buys the bonds. Technically, is the government assuming more debt there? We don't think so, because at the end of the day, if one hand is buying bonds from the hand that's borrowing, it's a net flat effect, right? From an accounting perspective for the government. The benefit of all this is they pin interest rates at zero. Everybody's able to refi. Businesses are able to refinance their loans at a much better rate. So people are individuals in their mortgage rates. So people are able to free up cash. That cash goes directly into the economy. So that's what's going on here, and that's definitely been a bullish development. And bullish events feed on themselves. You see the U.S. stock market strong like that. That's all-time high in the S&P 500. Household wealth is up, and people are feeling better, so they're out buying cars. Did you guys see that the U.S. car makers, GM, Ford, etc., Chrysler had, or DM Chrysler, they had their best year in 20 years. So going back 20 years, they haven't had a blowout year like that. So U.S. automakers have a good year. U.S. manufacturing is doing better than people thought overall. I'd still like to see some better numbers out there. Our Chicago Managers Purchasing Index is a little soft, actually below 50 last week. On the other hand, you can't argue with the momentum of these markets. So, yeah, potential breakout in the stock market. And here's the daily chart. You're seeing it too. Hey, let's take a look at the commodities. The gold market's still disappointing from our perspective. You really haven't, you recovered quite a lot in dollar amount, but percentage-wise, not a lot. Your secondary's down, day-to-day's down. That all-important 20-day pattern's still down also. So not a lot to get excited about gold about. On the other hand, if you're cheering for the economy, if you want to see the economy continue to put up jobs numbers such as they did just yesterday, by the way, last Friday's jobs numbers were blowout numbers. That helps explain stock market strength. So if you want to see strength in the economy, a sure indicator that the economy is getting back on a solid footing is weakness in the gold market. So weakness in the gold market, we translate that as strength in the overall economy. Let's take a look at crude oil, because this is a market that's I think this is causing the problems. Here's why you have those soft Chicago Purchasing Managers Index last week, because crude oil prices just won't go down. They're just stubbornly high. We think you have a ceiling here of sorts, but nonetheless, it can't hold those losses. It keeps coming back. So crude oil definitely a concern for sure. Ideally it's just meandering back and forth in an overall sideways range before they finally give it up. But that's really our biggest concern right now. And if you have any markets that you want us to check out, just go ahead and send us a note, and we'll check those out for next time. Hey, again, thank you so much. If you want to see what we have at Trading University, you can go to our site, trading-u.com. Thank you so much.